Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets of the corporate world. Today, Rent the Runway's latest report dropped, and let's just say they're trying to rent out more than just dresses, they're trying to rent out the future of their company with this recapitalization deal. Rent the Runway, or RTR, is talking about some pretty big changes, a recapitalization plan designed to basically fix their financial house. They're trying to get a new credit agreement, basically a new loan. And it all hinges on getting their stockholders to say yes. If they don't get the go-ahead, things could get really dicey, potentially even leading to bankruptcy. This is a massive risk for them right now. They've got a lot of debt, and if this deal falls apart, they might not be able to pay it back. Imagine owing a huge chunk of money and missing a payment deadline. That's where they could be headed if this plan doesn't get approved. And even if the deal goes through, there's a big catch. They're planning to issue a ton of new stock. This means the value of everyone's existing shares gets spread thinner, a concept called dilution. Basically, if you own 100 shares now after this deal, those 100 shares will represent a smaller piece of the company. Let's look at the numbers. As of July 31st, 2025, Rent the Runway had 43.6 million in cash. That might sound like a lot, but remember they also have 343.9 million in long-term debt. This debt is due in October 2026. If this restructuring doesn't happen, that debt becomes due much sooner, effectively in October of this year, which is almost tomorrow in corporate terms. Their total revenue for the 3 months ending July 31st, 2025 was $80.9 million. That's actually up a bit from last year, a modest 2.5% increase. But here's the kicker, their costs also went up. Total costs and expenses shot up by over 14% to $101 million. This is where it gets tough. Their gross profit, which is like the money left after paying for the actual items and getting them to you, dropped significantly. It was 30% of revenue this period, down from 41.1% last year. That means for every dollar of revenue, they're keeping much less money to cover other costs. And that brings us to the bottom line, the net loss. It ballooned to $26.4 million for this quarter, compared to $15.6 million last year. That's nearly a 70% jump in their losses. Now, companies often talk about something called adjusted EBITDA, which is basically earnings before a bunch of stuff. Rent the Runway's adjusted EBITDA also took a nosedive, falling from $13.7 million last year to just $3.6 million this quarter. That's a massive drop, showing that even before all the deductions, their core business performance is weakening. On the subscriber front, they've seen some growth with 146,373 active subscribers as of July 2025, up 13.4% from the previous year. That's a positive sign, showing they can still attract customers to their rental service. But even with subscriber growth, their strategy for acquiring new inventory is interesting. They're buying fewer items wholesale and more through share by RTR and exclusive designs. This means they're trying to manage cash flow. Their debt situation is truly complex. They've got this facility with Temasek, which has been amended many times. Most recently, they've been pushing back deadlines to agree on spending levels for inventory, operating costs, and marketing. It's like they're constantly negotiating to avoid defaults. And that brings us back to this major recapitalization plan announced in August 2025. They've struck a deal with their lender to swap a huge chunk of their debt for company stock. Essentially, they're giving up ownership to get rid of debt. This should reduce their debt load and possibly lower interest costs, but it comes at the price of massive dilution for existing shareholders. Now, here's something that really catches the eye of any investor. Rent the Runway admits they have material weaknesses in their accounting controls. This basically means they don't have strong enough systems in place to prevent errors or fraud in their financial reporting. One of the big issues is with their IT general controls. They're not confident in managing changes to their software, controlling who has access to sensitive financial data, or even making sure their computer operations are properly backed up and monitored. This is a serious red flag. If they can't fix these internal control issues, it could lead to misstated financials, failing to report on time, and ultimately it could damage their reputation and make it harder to raise money in the future. This is exactly the kind of thing that makes investors nervous. Beyond the immediate financial crisis, they're also worried about growing too fast or not growing fast enough. They're trying to balance expanding their customer base, keeping their brand appealing, and managing their internal operations. It's a delicate dance. And let's not forget, they're in a super competitive fashion world. They're up against everyone from other rental services to giant online retailers. If they can't keep up with trends or offer a unique value, they'll struggle. Their business is also sensitive to the economy. When people have less disposable income, things like renting designer clothes are usually the first to go. And with inflation and economic uncertainty, this is a big risk for them. So, looking at Rent the Runway right now, it's a company in a very tricky situation. They're trying to execute a massive financial overhaul to survive, but they're facing internal control weaknesses that make investors uneasy. Their subscriber numbers are growing, which is a good sign for their core business, but the increasing losses and high debt are serious concerns. The recapitalization deal is their big play to fix the debt, but it comes with significant dilution. The material weaknesses in financial reporting are a stark reminder that even as they try to restructure, they have fundamental operational issues to address. It really feels like they are making a bet on this recapitalization deal as their big play to fix the debt, but it comes with significant dilution. The material weaknesses in financial reporting are a stark reminder that even as they try to restructure, they have fundamental operational issues to address. It really feels like they are making a bet on this recapitalization deal as their big play to fix the debt, but it comes with significant dilution, the material weaknesses in financial reporting. Alright, that's our breakdown of Rent the Runway's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord in the description for more great discussions. Thanks for watching, see you next time.